Hello everyone, I am Zahra Fatima. Welcome back to my channel. Today in this video I am going to explain you the subject income tax. Under that the topic is income from house property. The subject income tax is for the students of BCom second year semester 4 students of Usmania University. Now under income tax the topic is income from house property. In my last videos I explained the basic theory of income from house property chapter, and in my last video I explained one problem also, and in this video I am again explaining you one more problem, that is problem of standard rent. So let's see the question. Mr. Raghav Reddy is the owner of a house property whose municipal valuation is 2,50,000 per annum and standard rent is 3,60,000 per annum, is let out on a monthly rent of rupees 25,000, monthly rent of 25,000, and the fair rental value is 2,10,000 per annum. Municipal taxes due rupees 30,000, out of which 15,000 is paid so far. Other expenses are repairs 4,000, insurance 1,025, interest on loan to purchase the house 45,000. The tenant has not yet paid last 1 month rent. Find the income from house property for the current assessment year. Students, for calculating income from house property, two conditions should be satisfied. The first condition, the asset must be owned by the assessee, and the second condition, the house, the asset must be let out during the previous year. So in this question both the conditions are satisfied. In the starting it is given Mr. Raghav is the owner of a house. That means the house is owned by the assessee. He is the owner of the assessee and he let out the house on a monthly rent of rupees 25,000. And he let out the house also. So two conditions are satisfied. First, the house is owned by the assessee, and the second condition is the house is let out during the previous year. And for calculating income from house property, first we have to find out the gross annual value. For calculating the gross annual value, we consider the four values. Number one, municipal rental value, that represents MRV, then fair rental value, rent of similar house, then standard rental value, and the last one, actual rental value. In this question, standard rental value is given and municipal rental value is also given, fair rental value, and monthly rent is given. Monthly rent is called actual rental value. If you multiply it with 12, that value represents for 1 year. That is our actual rental value for 1 year. But in the question it is given the tenant has not yet paid last 1 month rent. That means the assessee received 11 months rent from the tenant and 1 month rent is still due. So that we will see while calculating the ARV, actual rental value. Now before that, first we calculate the gross annual value. For calculating the gross annual value, we have to do the workings. In the working part, first step, calculating ERV, expected rental value, highest of the following two amounts. Step 1, calculating expected rental value, higher of the following two amounts. Number 1, municipal rental value, and number 2, fair rental value, MRV, FRV, and both should be per annum. So in the question, municipal rental value is given 2,50,000 and fair rental value is given 2,10,000. So MRV 2,50,000, fair rental value 2,10,000. So from this two, the higher value is 2,50,000, that is municipal rental value. So higher value is taken as ERV, expected rental value. Now the second step is calculating adjusted ERV. Adjusted ERV, least of the following two amounts. Adjusted ERV we calculate when standard rent is given in the question. So adjusted ERV, number 1 ERV, number 2 SRV. ERV as per step 1. Just now we find the ERV. ERV in this case is 2,50,000. And next is number 2 SRV, standard rental value. Standard rental value is given in the question. Standard rent 3,60,000 per annum. In step 2 we have to see the least we have to select. Calculating adjusted ERV, least of the following two amounts. So here ERV, SRV 2,50,000, 3,60,000. The least is 2,50,000. This least amount is called adjusted ERV. Now afterwards, step 3, calculating gross annual value, higher of the following two amounts. Number 1 adjusted ERV as per step 2, and second one ARV, actual rental value. Now separately we have to find the actual rental value, ARV. For ARV, the formula is rent received plus rent due. Here the SSC received 11 months rent from the tenant, because last 1 month rent the tenant has not yet paid. That means 1 month rent is due. The SSC received 11 months rent, and in the question it is given monthly rent rupees 25,000. So 25,000 per month into 11 months, we get 2,75,000, and 1 month rent is due. 25,000 into 1 month, 25,000. So 2,75,000 plus 25,000, total 3 lakh. This 3 lakh is our ARV, actual rental value. Now calculating GAV, highest of the following two amounts, adjusted ERV and number 2 ARV. Adjusted ERV as per step 2 is 2,50,000, ARV is 3 lakh. So higher is 3 lakh. So this 3 lakh is our gross annual value. So after calculating gross annual value, we have to draw the format. The format is particulars and inner column, outer column. But on the top we have to write the heading. Computation of Mr. Raghav income from house property for the assessment year 2023 to 2024. So under the format, first we have to write gross annual value, which we find just now in the working notes, that is 3 lakh, GAV. From the gross annual value, subtract the municipal taxes. In the question it is given municipal taxes rupees 30,000, out of which 15,000 is paid so far. So in my previous video I told you municipal taxes is allowed on payment basis only. Here municipal taxes are 30,000, but out of 30,000 only 15,000 is paid so far. So the municipal taxes which is paid, 15,000 is paid, so that 15,000 is allowed for deduction. So 3 lakh minus 15,000 municipal taxes paid. So outer column 2,85,000. From the GAV, if we subtract the municipal taxes, we get the net annual value. So net annual value, that is NAV. NAV. Here NAV is 2,85,000. So after getting net annual value, we get the deductions. Deductions under section 24. Under section 24, first deduction is standard deduction. And this standard deduction is fixed, that is 30% of NAV. This deduction is compulsory deduction. It is a statutory deduction. So 30% of NAV. NAV 2,85,000 into 30%, 85,500. Inner column we write the amount. Under section 24, two deductions are allowed for computing income from house property let out. The first one, standard deduction, that is 30% compulsory deduction. And the second one, interest on loan. If the SSC paid the loan, or if the loan is due, interest is, if the SSC took the loan for purchasing the property, for constructing the property, for repairing the property, for reconstructing the property, if the interest on loan is paid or interest on loan is due, both interest on loan paid and interest on loan due are allowed for deduction. And in the question it is given interest on loan is to purchase the house. Interest on loan to purchase the house is 45,000. So interest on loan taken to purchase the house 45,000. It is allowed for deduction. So 85,500 plus 45,000. Total deduction amount is 1,30,500. So this should be deducted from NAV. 2,85,000 minus 1,30,500. Remaining value is 1,54,500. This represents income from house property let out. So the income is 1,54,500. Income from house property let out. So with this we complete the problem. If you like the video, then give a like, and if you are new to my channel and if you not subscribe my channel, please subscribe the channel so that future notifications related to my future videos will come to you directly. And students, very soon I am going to explain you other chapters like income from capital gains, income from business and profession, and income from other sources. So students, stay connected with us and inform your friends about the channel, about the videos, so it helps to you and your friends for the preparation of your examination. And students, thanks for watching the video. All the best for your examination.